Hello, everyone. This is at Whitbread, and I will be presenting our final project for operations research on behalf of myself, Jose, and Zun. The project that or the topic I should say that we settled on was portfolio optimization, and we'll talk a little bit more about really what that means. It's um, can be definitely a different couple things depending upon how you approach the problem. So, from an introduction standpoint, really what we're looking to do here is to create an optimization process with the goal of replicating the returns of an index. So this is very much akin to what's known as direct indexing, which is very big in the investment industry right now, where essentially you're looking to create an index of holdings that track an index performance, both in terms of the returns, but as well as the risk characteristics. It's a pretty deep subject, and we didn't dive super deep into it here. We decided to take a look at one example of an optimization based upon the data that we had. But the reason that we selected it was it fit within the realm of what we'd spoken about in classes, uses some interesting models, and is also somewhat applicable in terms of what's happening right now within the industry itself. So, as I mentioned for this analysis, we used historic monthly returns as a means to analyze and replicate an index. And we'll talk about the different goals we use to do that and what the outcomes look like. In terms of what we used for variables was 27 country-specific exchange-traded funds, or ETFs. There's nothing really specific about the 27 other than to say we felt as though it was a pretty round representation or complete representation in terms of the general universe that we could use to replicate this index. The index that we're looking to replicate is the MSCI World Index, which essentially is a developed as well as emerging market equity index. And the process that we employ within this, and we'll get into further detail on this, is a nonlinear optimization process. And the goal was to decide what the portfolio's optimal asset class weights. In other words, what would be the weights of each individual ETF that would generate a portfolio with returns that looked as much as the like the index as possible. And again, we have a couple different. We evaluate that based upon tracking error, and we'll talk about that a little bit more going forward. So we employ three different objective functions here. So we did essentially three different optimizations. The first was a mean absolute deviation. Another was a min-max problem, and then lastly, least squares. And then we rounded out the analysis by looking at this to see how well this performs on out-of-sample returns rather than the entire sample of data that we looked at. So from a methodology standpoint, I mentioned already that we utilize a nonlinear optimization process. That's because the way this model is set up is it's not linear in fashion, and we'll talk about why that's the case and how the data comes about. And again, we looked at 27 different regional focus ETFs. We show them here within this slide. I won't go into all of them, but you can see that it's a fairly robust universe of funds, both developed as well as emerging market. In terms of data, we used 10 years of continuously compounded monthly returns, and we got that downloaded from Bloomberg. And in order to do the analysis, we use Excel Solver's nonlinear generalized reduced gradient, or GRG engine, to optimize the portfolio weights. So the optimization process is used to determine what the initial weights of each ETF would be in the portfolio. So this is not a rebalanced portfolio. It's essentially saying optimize the weights that start off with, and then the portfolio returns will then flow down from those initial weights. So I provide an example of essentially how that's calculated because it can be a bit confusing as to where this all comes from. So once the weights are determined, in other words, once the optimizer determines the weights, and for this example, we'll just say that simplistically there's only two assets in the portfolio. 75% is in the S&P 500 and 25% is in Japanese stocks. So we start off with $100 in the portfolio, 75 goes into the S&P 500, $25 goes into Japanese equities. From there, the returns grow based upon the unique performance of those two individual ETFs. The performance each month is then summed across. So the summation of the performance of each individual ETF results in the overall performance of the optimal portfolio. So that's how we generate our monthly returns based upon the various ETFs that are held within the optimal portfolio. And again, it's not rebalanced. It's set once at the beginning, and then each individual return structure essentially dictates what type of drift gets put into the portfolio in terms of the overall weights over time. So once we have that portfolio created, or at least once the optimizer, I should say, has created that portfolio, it results in a vector of monthly returns, which we call X. So X is the returns on a monthly basis of the actual optimized portfolio. Y is then the vector of the monthly returns for the index itself. We say benchmark here. It's the same as an index. The weights denoted as W1, W2, W3, so on and so forth, all the way to W27 are the variables or the weights of each individual ETF, and those are the variables that the optimizer is changing to determine the optimal allocation mix. And as I mentioned before, we're looking at three different objective functions. So we run three different optimizations based upon each of these different objective functions, and resulting in different weights each time. Not meaningfully different, but different nonetheless. So the first objective is to minimize the maximum of the absolute, I should say the absolute value of the difference between X and Y. That's the min-max objective. The mean absolute deviation is then we look at to minimize the average of the absolute value differences between X and Y. And then lastly, the least squares looks to minimize the sum of the differences between X and Y squared. From a constraint perspective, we didn't have to put too many into the model itself. The two that we needed to put in was one, we had to make sure that the weights summed to 1. That way the model wouldn't look to partially invest. So we're going for obviously a fully invested portfolio. Wouldn't look to just invest 50% or something along those lines. And it also wouldn't go beyond something. In other words, try to use leverage in some sort and use 150% of a particular ETF. And then lastly, all weights are non-negative. So again, that's basically just a short constraint. So we're not allowing the portfolio to go short. In terms of the results, again, as I mentioned, each individual weights are then evaluated, well, I should say each individual weights that are optimized according to those three objectives are then evaluated based upon tracking error versus the index. So again, it's similar in terms of the objectives that we looked at before, but somewhat different. So the formula for tracking error is presented here. It's the difference of the portfolio returns from the index returns squared divided by the number of observations minus 1, and then with the square root taken of that. The table here shows the tracking error results of each of the different portfolios. And interestingly enough, they're very close to one another. I believe you show them. No, that's the out of sample. So they're very close to each other in nature. The least squares looks like it somewhat outperforms the mean absolute deviation, and then as well as the min max. So there's not a lot of difference. And the real takeaway here is, surprisingly, a very simple optimization process looking solely at historical returns over the full 10-year sample period can actually generate weights that result in pretty low tracking errors on the portfolio itself. And again, the big takeaway, well, not say the big takeaway, the big caveat here is we're not rebalancing. So those weights are set once 10 years ago, and then they drift only according to the returns within the actual ETS themselves, and still results in a pretty meaningfully low tracking error. So we were surprised pretty pleasantly with the results of what this looked like. But then in order to really test this a little bit further, we thought it made sense to look at this from an out-of-sample perspective. So we followed the same process with the same three objectives, except this time what we did is we had the optimizer look at the first 84 months or 7 years worth of returns to create the optimal weights within the portfolio. Once those weights were then created, we then used the last 36-month period to as a starting weights, and then evaluate and then create a return stream, or I should say a vector of monthly returns based upon those weights. So again, it's using out of sample monthly returns in order to build a return structure. So what we show here within the table is the out of sample versus in sample. So there's a number of different takeaways from this analysis here. Interestingly enough, and get into them a bit in this slide, we reproduce the same table below so you can see it as we talk through this. Um, right off the bat, the in-sample data shows a meaningful um, degradation, for lack of a better term, in terms of the actual tracking error itself. So they're meaningfully higher than what they were over the full sample. So that's interesting and fairly meaningful, up from 1.5% up to 5% in terms of the tracking error for example, the least squares method. What's also interesting is the fact that what you would expect in the min max as well as the least square is the tracking error to be um, increased between from out of sample from in sample to out of sample, but that doesn't happen with the mean absolute deviation. The tracking error actually improves when we go to out of sample data, which is kind of exactly the opposite of what you'd expect from there. So it might be spurious, it might just be something that's somewhat unique in terms of what the data looks like, but from our perspective, really, the main conclusion that they kind of pull away from here in terms of the out of sample data is it looks like even though that the full sample optimization generated some pretty small tracking errors, the out of sample calculations suggest that this process just isn't robust enough to construct an index tracking portfolio. And we mentioned that within a reasonable tolerance band of tracking error. I mean, everybody's opinion is different in terms of where the tracking error goes. But if you're talking from a direct indexing perspective, these are fairly meaningful levels of tracking error than you'd expect through that. So initially, we were surprised to see the results come in as positive as they were. But then when we tested them from a sample perspective, they looked a lot more akin to what we really expect. So lastly, kind of to finish up in terms of the limitations and the further work that we have here, so the first of it, which is there's an inherent limitation when you run a nonlinear optimization, and that is the fact that you don't really know whether or not that the optimization is finding a local optimal solution or a global optimal solution. One way to theoretically test for this is to test for convexity, but likely be done through a much more sophisticated analytical solver. But if we were to test through convexity, we could at least eliminate that as a potential risk to the analysis itself. Another limitation is the number of securities that we can analyze within the portfolio itself. So the solver, the Excel solver, only allows you to look at 200 variables. So in this instance, that wasn't much of a limitation. But if we were to try to take this process and apply it to something perhaps a bit more applicable, like, for example, a real world example might be somebody trying to replicate the returns of the S&P 500, which is 500 equities within an index. If they wanted to do that by perhaps only holding 100 securities, the optimizer would still have to essentially, quote unquote, shop through 500 different equities to determine what the optimal weights were in order to replicate that index. And that's just not something that this optimizer could theoretically handle. One potential solution to that might be to extend the analysis out to a goal programming approach and look at factors such as price to earnings, dividend yields, market caps, and so forth in order to try to limit the data set down in terms of what we're looking for. But again, if we were to use the same example of the S&P 500, it's likely that we would still need that data across all those different holdings. And it's, again, unlikely that the optimizer would be able to handle that. The real solution for that limitation is likely to use a commercial grade optimizer. And the way that those typically work is they employ what's called a pairwise swap gradient method, with the goal of optimizing an objective function determined by the user, which is an interesting caveat. So the tracking error could be what you're looking to optimize. You could also be looking to optimize exposure to particular factors, weight within certain areas of the portfolio, or whatever it might be that you're looking to optimize. But the way that the pairwise swap gradient method works is it looks to buy a portion of what it considers to be the best asset based upon margin of utility, and then sell a portion of the worst asset, again based upon margin of utility, and continuously make those swap trades until nothing else, no other swap trades really improve the overall objective function. So that would be likely the best solution if one were to go forward with what he considers to be a bit of a direct indexing approach. But it was an interesting experiment in terms of trying to put together a relatively simplistic optimization process and evaluate how close it gets to what would theoretically be compared to a much more robust, what we consider to be commercial grade optimization. So that's it. That's the entirety of our presentation. I hope everyone enjoyed it, and thank you very much.